Hello, everybody. Welcome to today's webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Today's our webinar title is Build a Consistent Portfolio with Unit Trust. Welcome everybody to this session. My name is Shen Chu. I'm the moderator for this webinar. So in this session, we're going to explore how do we build a consistent portfolio with unit trust and how do we evaluate the unit trust performance. But before we begin, as usual, disclaimer. Whatever we share in this session is only for educational purpose. In no way that I give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. Allow me to introduce our speaker today. He graduated with a bachelor's degree in finance and investment. He completed the CFA program on one attempt. And he has over 5 years of investment experience with a focus on trading Malaysian and US stocks, commodities, and index futures, applying fundamental and technical analysis. He has over 2 years of investment teaching experience with over 500 students, and he's an expert in wealth management and financial planning. So he's none other than Mr. Dibo Chua from Bullbearbursa. Hello, Dibo. How are you today?
Hello. I'm great. Thank you.
Yeah, good to have you here on our segment today.
Yeah,
so without further ado, let me just hand over the session to you.
Okay. Let me share my screen right now. Just give me a moment here. Okay. Okay, I've shared my screen, right? So I think everyone is looking at my screen right now, I hope. So we are on this learning outcomes, okay? So things should be okay, right?
Yes, we are seeing your slide.
Okay, so, all right, let's start. Okay, so everyone, good evening right now. So my name is Dibo Chua. So today I'll be the speaker for this topic. How do we build a consistent portfolio with unit trust? Okay, so I believe all of you, most of it already heard about what is unit trust. And, you know, somehow in your life, you encounter, most likely in the banks, about this thing. Maybe some of you might invested in it before as well. Good outcomes or bad outcomes, I'm not sure of it, but there's a lot of it, all kind of possibilities. But today we will talk about straightly onto what is unit trust at all. So we'll try to learn about unit trust all over again, okay, today, and then we will talk about how do we use unit trust, to help on your investment. Okay, so this is a very key part. A lot of people they have a lot of complaints when it comes to unit trust, but typically I always ask the questions like, when you complain about a product, is it really the product problems, or is it you are the one that using the wrong strategy? So a lot of times it's probably the person that actually using the wrong strategy with unit trust. So that is why your investment is doing not that good, not that well. Okay, and then of course we'll talk about what are the risks of unit trust and also what are types of unit trust. We'll talk about both of it in this section. And then the last part, which is the juicy part of it, we'll talk about how to strategize your investment portfolio with unit trust. Okay, so without further ado, we'll just start for this section. Okay, so typically we'll just give a heads up, like what is a unit trust. Okay, so as we all know out there, there is a lot of investment, be it like shares, companies, common shares, bond, or commodities like gold, or oil, rubber, anything, you name it. Okay, and then with all these products, there is typically people, some of it, they will also know that they will go to bank. Some of it, maybe you are very conservative investors, you will go to bank, you go for FD deposits and all this. But most of the time, when you go to the bank, you ask for deposit FD, right? So the banks will always talk about this thing, funds, okay, unit trust, or what it calls like mutual fund. All of the terms is totally the same thing, okay? But at the end of the day, what actually this unit trust mean? Okay, so to give you an idea, we have to go back to understand about investing. Okay, so if we talk about investing, right, then you only know why is unit trust invented. So typically, if we talk about you investing, investment, there's always two ways to do it. Okay, the first of all, of course, is do it yourself. Okay, so which means you are DIY. you are researching companies, you are researching commodities, you are researching economics, sentiments, news, and all these things yourself. Okay, do it yourself. So you do all of the research yourself, you do all the effort, you put up the capital, and then you do up all the strategy. So this is typically how we start. Most of us start investment. Okay, but actually, instead of doing all these things yourself, right? So most of us, maybe we are in a different field. Sometimes we are in engineering, or maybe we do for F&B business. So a lot of times, these kind of people, they don't really have the time and the effort, to do all the work, all the dirty work. So because of this, so for us like professionals, you can have another ways, which is to allow the professionals to do it for you. So this is why unit trust is actually invented. So it helps you to, free up a lot of your time and energy, so you can have another way, an alternative way to grow your wealth easily. Okay, so this is why unit trust is invented, to allow the professional to do it for you. Okay, and then we will look at how the unit trust actually works. Okay, this is a very beautiful thing to talk about. To be very simplified to go through it. Okay, unit trust is actually a very, I would say, it's much more like a collective pool of capital, and then put into the right investment, getting the right returns, and then give it back to the investors. So this is the simple statement of it. So if you look at the number of it, so this is number 1, number 2, and number 3. So the flow is going down like that. So first of all, is of course, all of us, like we are the one that don't really have the time, don't really have the effort, don't really have the energy. We try to pull our fund all together, maybe like 100 million, and we give it to the trustee. And then the trustee is the one that holding on the cash, and they will give it to this so-called unit trust manager, which is the professionals. Okay, so they give it to the managers, and then the manager will invest it, okay, in all kind of capital, in all kind of assets. Okay, so be it like cash, deposit, stocks, properties, commodities, or anything. Okay, so be it like, for example, bitcoins, the new product, new asset class. It can be one of it as well, maybe in the future. So these are the choice that the asset manager, okay, or we call it the unit trust manager, they make the decision with the fund to invest into it. Okay, and then if the investment somehow comes materialize into a good returns, so the returns will come in the form of dividend and also capital gain. So then they will distribute back to the investors. So this eventually helps up a very healthy cycle, okay, a very healthy cycle to allow for people to invest at very, very easy way. Okay, so as you can see, unit trust is a very beautiful things, and a very good things to allow people to have investment. But then, okay, of course, as I said in the beginning, a lot of investors, they will have a lot of complaint on unit trust. Maybe it's not you. Maybe you can ask about your friends, or ask about your families, your parents. They will have all kind of complaints. And typically, the complaints that I always get is all these 4. So these 4 complaints, like the first one, they say unit trust always loss making. Okay, so this is very, very bad investment. Don't do it. So this is, I do get this kind of a comment a lot, and then so we will talk about it later. Okay, so complaint number 2 is like unit trust charges are very, very high, and the third one is like unit trust is so long. Okay, it took so long to invest. Okay, it's like taking ages or maybe like decades to really to have the returns, something like that. I might as well put in FD. And then the last one are probably the one that actually have some kind of investment strategy, have some kind of investment experience. Then they will always say this: "Are you unit trust? Don't want. I go for stocks. Much better." So you will have a lot of comments about unit trust, something like that. Okay, but as I said, a lot of times, once we go into this today's webinars, you will understand why a lot of times it's actually the people, it's actually the persons that actually did it in the wrong way. Okay, they have the wrong strategy on unit trust. So at the end of the day, it becomes not that efficient. to make money for them. So it comes up with wrong expectation. And because of that, they have all these kind of complaints. Okay. So as you know, one of this product, right? This product is, I would say, it's much more an easy way for you to invest. Okay. So, but be it like I said, it's an easy way, but it's not, like for the best, highest return and all these things. So you have to understand about this concept before going to unit trust. Okay. But if we continue for this webinar, we will go into the second section. So how does a unit trust actually help you? So as we said just now, we already explained what is unit trust on surface. Typically, this is how unit trust works. Okay, this is a pool of fund, they invest and all these things. But how does unit trust actually really help you? So to give you an idea, unit trust, it helps the people, they actually do not want to do the research. Okay, so I can give you a lot of context. If you really want to invest into something, okay, not to say into stocks only, even into bond or gold or oil, all kind of stuff, you will have to do a lot of research. Okay, so if you put it into the easiest way to invest into stocks, like maybe Maybank stocks, you still have to do a lot of research, whether they are having a good chance to go up in price, whether they are going to continue paying the dividend and all this kind of research. But for unit trust holder, they don't have to do all kind of work. Okay, they will have a rather much different strategy, and this kind of strategy is much more easy to maintain for them. Okay, so typically unit trust is very suitable for people that don't really have the time, don't really have the knowledge, and don't really have the market sense. Okay, if you are these kind of people, then you are very suitable to invest into unit trust to grow together with time as time passes. Okay. But then how does it really help you? Okay, as I said, it's very suitable for all these kind of people. But why? So to understand about this concept, okay, to grow your wealth, right, you have to understand, if you want to grow your wealth, there are a few elements that are very, very important to make it happen. Okay, so this includes the first one, of course, is the capital. Okay, because you need capital to invest. Okay, if you talk about you only have a few $50 or $100, something like that, you are very hard to grow. Okay, you at least gonna have like at least probably like hundreds of thousands, that kind of a capital. Then only can slowly invest and grow your wealth. Okay, so this is the first element that is very crucial. Everyone understand, I believe. And then the second element is about time. Okay, to invest, you need time to materialize the investment. Okay, be it, for example, you just want to invest into stocks, you got to be patient as well. Okay, if today you talk about you want to just invest into Maybank stocks, you cannot be the one that actually hoping Maybank stock to just burst from 8 ringgit to 10 or 16 ringgit tomorrow or maybe next month. So you shouldn't have this kind of expectation. So to invest, you really need time. Okay, you need time to slowly for the product, for the investment to materialize, and then your strategy once it works, so you can see the prices slowly going up, and then from there you are able to grow your wealth. And then these two elements, I think most of us understand easily. But the third element, it's all about the efforts. Okay, as I keep on mentioning emphasis on this element, efforts. So as I said, effort, what is the effort means? Okay, as I mentioned, it is about the research and the analysis. But it's not only that, So it also about the knowledge, the understanding, understanding about the economics, understanding about finance and all this stuff. And the last thing about it is the discipline. Okay, so this is the toughest part of elements during your investment journey, the discipline. So because a lot of people, they can't invest successfully themselves, DIY, it's mainly about this part because they don't have the discipline to follow their strategy. Okay, so because of that, most of them, they just fail their investment. Okay, so these three elements are the very crucial items that we need to have, to grow your wealth. But unfortunately, most of the time, we can only have these two. Okay. The third one, most of the time, because of probably different line of work, okay, maybe we are in engineer, F&B and all kind of stuff, different line of work cause us to not have the knowledge or the understanding or even the time to, put up effort to do research or even just to follow the investment strategy. So because of this, right, it's very hard for us to really DIY, grow our wealth. Because as I said, three elements, it is a must-have to allow your wealth to grow. So without one of it, it's very hard. You will just be banging on the wall and keep on failing and failing. So you gotta have three elements at least. So because of this, right? So unit trust is invented, and unit trust actually help you not to have doing all this stuff. Okay, by how? So the first of all, of course, is because of the professional management. So because unit trusts are managed by the experienced fund manager who have the time, have the knowledge, and the discipline and the effort to do all the dirty work for you. So basically, they are the one that make the informed investment decision for you. And the only thing you need to monitor, it's mainly believing on the people, so believing on the experts. Okay, or I put it another way, it's much more like a people analysis. So if you put it into unit trust, you don't have to monitor on the investment. Okay, you just have to monitor whether the professionals are doing the work for you correctly, or whether they are really looking it for you, whether they are helping you to monitor it, letting you know, notice letting you know to have about all these things. So this is the first part, how unit trust actually help you. And then of course the second thing is unit trust also allow you to use a very small capital to own strong company. So companies like Tesla, Apple, Google, Meta, all these mega companies in United States. So these companies, if you really just talk about only on one stocks, each of them, right, you need probably like 10K to own all of it. But with unit trust, you can have like as low as 1,000 ringgit, and you can own all of the returns from these companies, these incredible companies. So because of this, unit trust is a much more easy way for you to invest, and especially for the students and or maybe for the starter. So you guys can really try on unit trust to understand about investment. How is it like, and how does it affect your emotion and all this stuff? Okay. And then the third part is, of course, the liquidity. Okay, so this is also a very important part because a lot of people, they actually neglect on this thing because they always think that investment is very easy. As long as you just go and buy stocks, own it, loss making, hold it until it becomes gain. So that is kind of like a really wrong strategy, to be honest. But it's not really typical that way, okay? Because you have to understand about the time taken, the liquidity and all these things for you to have really materialize your investment. But for unit trust, you don't have to worry about this thing because unit trust, if you want to buy, you can easily just buy it. You don't have to queue up, waiting for the price to hit. Then only you can complete your orders, really match the investment, the stocks. But for unit trust, you just have to buy from your bankers or from your investors, advisor, okay? And then you want to sell, if you want to sell, you can just sell it, no worries. It's very easy to sell as well. You don't have to really wait. Only there's a buyers from you, then you can sell it. You don't have to do that. So because of this thing, it's very, for the risk level, it's much more lower as well for unit trust. Okay. So those are the basic things that we just went through, including what is unit trust and how does unit trust actually help you. Okay, so from this slide onwards, it will be much more technical to understand what are the risks of unit trust and how can we actually strategize using this product. Okay, so to give you an idea, first of all, of course, we have to understand how many types of unit trusts are there in the market and what are the risk level. Okay, so if I will put it all of it into a slide, right, it will be just 5 categories. very easy to understand. So as you can see, it's a low risk to high risk for the vertical scale here. The lowest one, money market, it will be the lowest risk. Money market is much more like a product in a bond kind of a product. Okay, it's much more like a bond. So which means money market is actually companies, they are issuing bonds to lend out money. Okay, and then they will give a fixed interest to people. But typically money market, because it's much more like a low maturity assets. So most of the time it's a 1 year or maybe as more 2 year things. So because of that, money market, we always say that the lowest risk of this unit trust is just like a FD for you. This is much more like a parking facility, okay, instead of investment, I would say, much more like a parking facility, okay. And then going up to bond fund. Bond fund, it's a riskless product as well, okay, because most of the time bond is much more conservative, so it's also very suitable for the people that couldn't tolerate any volatility. Okay, so you can look for this bond fund if you think that you can't go for the highest risk, and you just want to go for low risk, maybe 3 to 5% per year. So this is the choice that you can go for. Okay. And then the third one will be the balance funds. Okay, so I will skip this balance funds first. Okay, I will go up to equity funds. So equity funds is the one that we understand about. Equity, as you said, it's common stocks, which is the shares that we understand, like Maybank, Public Bank, RHB, all kind. This is much more like a riskier funds, much more like a riskier asset class. So if you want to invest into equity funds, then you better have the expectation that you are going to take on more, I would say, volatility risk. Okay, you have to take on more risk. But of course, for equity fund, it's also very important to understand it's not just stocks onto all of the global rules, something like that. They can be categorized into a very different kind of way. For example, geographically, we can say that we have US equity funds, or maybe if you talk about you want to go for China, there is a China equity funds as well. So as you can see, using unit trust, you can also very easily own different kind of products, different kind of returns all over the world, instead of just Malaysia companies. Okay, or if you want to go for even higher risk level, so this will be the specialized fund. Okay, so what does it mean by specialized fund? Specialized funds actually means by it comes with a team. Okay, so the most typical team that specialized funds have is this technology funds. Okay, so there's a different kind of names of it, like global technology, maybe like Hong Kong tech, something like that. So as you can see, this is a much more specialized. They are going into this specific technology companies. Okay, technology stocks. So technology stocks, as you can see, they are very, very volatile. Okay, the prices goes up and goes down very, very quickly. For example, Tesla, Facebook, all this, the beginning of the year, they probably like $10, and then today they really like triple and double already. So these are the funds that are much more higher risk. Okay, so you have to bear with it for the cycle. Okay, as you goes on with the time. Okay, and then we'll come back to this balance funds. Okay, balance funds. What does it mean? Is that it is actually the mixture of equity fund and the bond fund. Okay, which means that it can have a mixture of probably 60% in equity and then probably 40% in bond. So it's a much more easy way for you to not have any monitoring, because if you want the easiest way to invest into unit trust, you can just look for the best balance fund in the market. Okay, you can just go into maybe all of the bankers, look into Bursa anywhere, look into Bursa marketplace. So you can go to the website and then you try to look for balance fund, the best one, the best performance out of the last 10 years. So once you choose of it, then you can just go on and invest in the long run, and you don't have to worry anything, because the fund manager, what it means by balanced fund is, it means that they can invest into equity and also bond themselves, and they will decide themselves when to invest more in equity or bond. Okay, so like for example, right now, for our markets, Malaysian market, just for Malaysian market right now is much more volatile, and it's very hard to say there's a much more upside at the moment. So this is a time for you to kind of like invest more into equity, because the prices are much lower. So the fund manager for the balanced fund, most of the time right now at the moment, they will just invest into equity. Maybe back in the years of 2021, because most of the equities, most of the stocks in Malaysia are high in price. So the balanced funds manager, they will just choose to invest into bonds. So this is the strategy that they do for you. So you don't even have to choose on how many percentage yourself here and there. You just go all into balanced fund also can. Okay, so here is all of the picture for the whole idea of what is types of funds, what is the risk. But I think some of you may have the idea that when you look into this picture, right? So when I ask you guys about one question is that, what do you think is the best fund for you to invest? So you can ask about this question to yourself, and maybe write in the chat box there, so I can see how many of you is actually really interested, whether in the high volatility or the low volatility conservative fund. Okay, so what kind of funds you think that is the best one for you to invest? I see some people actually write that they like REITs. Okay, this Yiming, very interesting because he likes REITs. REITs is a much more, I would say, slightly low risk investment. So it is equity. Okay, it is equity, but because of the nature of REITs, it's much more not that high volatility. It's a good one. It's a good one actually. So most of it I can see some of the replies. Most of it it's equity. Not much of the people thinks that balance or bonds is the one to go. But I think because right now we are talking about theoretically, but a lot of times, right, when you are going into investment, some of us will always have the idea that we wanted to just try not to lose our money, okay, at all. We just want to gain slowly, takes our time. No, never mind. We just want to grow slowly, not to lose the key thing, okay. So I believe a lot of us also likes bond fund or money market fund, okay, because these kind of funds, right, they actually give us, I would say consistently, if you just invest into bond funds, per year, they give you 4%, 5%. You don't have to worry anything. You just slowly grow, and you don't have to even worry about losing, okay. So some of us may have this kind of idea, but let me tell you why this is maybe not the good idea if you want to invest unit trust in the long run, okay. So I draft up some of this information data, and I compare on their returns. Okay, so what I did is I put up the stocks returns, the bonds returns, and also the balance funds returns. Okay, to compare, to allow you guys to understand about these three products, this three category, we can say. Okay, and I put up from COVID-19 to up to probably around 100 years, 90 years, up to the last one, to Great Depressions, okay, 1930s Great Depressions. So we will look at all these products, right, how they compounded, okay, each year, how they compounded up until today. What are the returns? Okay, so this will be an interesting slides. We'll go slow here, okay. So the first of all, we'll look at the timeline of COVID-19. Okay, COVID-19 2020, year 2020. The stocks actually compounded up until today, 2023. We actually up by 37%. Okay. great return, to be honest. Okay, great return, which means if you put up 1,000 ringgit into stocks, right, from 2020 up until today, your investment it's up, I think probably like doubles already. So it's a great investment for stocks back in the day of COVID-19. For bonds, not so much, negative 5%, not so much. I think, as you can see here. Balance fund, it's normal, okay? The return is between of them, 19%. A good return as well, not that bad, okay? But I would say this data, COVID-19 until today, it's not a very big sample size. So it's not a very good data. So we cannot use this data, okay? So let's maybe lengthen it a bit. Let's hold it to maybe Great Recession, 2008. Okay, 2008 up until today, it's 15 years. Okay, 15 years. So 15 years, we can see the stock returns is still 10%. I say pretty good. Okay, because for usually stocks performance, we will say that as long as it's around higher than 8%, then it's a great investment. Okay, for bonds, this sticks to the same 5 to 6%. So as I said, it's around like 4, 5, 6, something like that. Very stable, compounded, just like that. Balance funds, it's 9%. Okay. So as you can see, even in very bad times like Great Recession, stocks, they are still performing very well. Okay. So the people that actually choose for stocks investment is a much better choice. Okay, as you can see up until now. Okay, maybe we lengthen it a little bit further now. Let's go back to dot-com bubble. Okay, dot-com bubble, this is the year 2000. And to give you an insight, dot-com bubble could be stated as the biggest bubble, the biggest stock bubble in our history, because the prices back then, it was crazy. As long as you are the company, you just mentioned that I am doing the internet business, millions will be pouring into your company. So only one statement made and everything will just give it to you. This is back in the good days, but as we all know, because it's a dot-com bubble, right? It's a stocks bubble. So supposedly for stocks, it will be a very bad day, okay? Because back then, stock prices is very high. They take a very big hit, okay, for their investment. So because of that, as you can see, stocks, the return is actually much lower as compared to just now, 2008 subprime crisis, the Great Recession crisis. So as we can see, it's only 7.5. Bond, it's a different story, okay? Bond, it's a very good year, up to 6.7. You know why? Because during the dot-com bubble, we have a lot of interest rate cut as well. So just to give you a simple idea, whenever our Bank Negara Malaysia, okay, whenever our central bank in an economy, if they declare to say that our interest rate is lower for this particular time, okay, your bond should perform better, okay, because this is just how the finance works. So if you want to dig down deep even further, then you can go and look for it. But this is just a easy theory to understand. Whenever the Bank Negara Malaysia, whenever the central bank, they announce lower interest rate, okay, to stimulate the market, your bond prices will go up and then your return will be higher. So as you can see, dot-com bubble, the bond investment is much more better choice because it gives up to 6.7%, which is pretty good, because as compare, bond is actually most of the time 4 to 5%, but right now it's close to 7%. Balance fund, still the good one, okay, 7.8%. I would say it's still pretty good. And then we pulled it even further to 90 years time. Okay, Great Depression, 1930. Okay, this is the year 1930, Great Depression. And to be honest, this is the sample size that we are looking for. Okay, at least 90 years of sample size. And from this, we are able to understand the long-term return of the three products. So for the stocks, it's 9.6%, pretty good, the best one of it. The bonds, 5.6, and then the balance fund, 8.5. So simply from this slide, sorry, and the sample size of it, since 1930 until 2023, you can see the return. It is much more staggering. For stocks, it is almost double for bonds, okay, the compounded return. Okay, maybe just looking at the returns, you are not that shocked. If we put it into dollar terms, let's assume that you invest 10,000 into stocks and 10,000 into bond and 10,000 into balance fund. Until today, it will be worth stocks 43 million, balance fund 17 million, and for bonds, it's only 1.4 million. Okay, so from this slide and from this data, we can conclude one thing. Okay, if you want to invest into unit trust, okay, it's much more better for you to invest into growth, okay, taking on the risk, okay, because it grows better when time passes. So as I said just now, looking at the data since Great Depression until today, a 10,000 investment can give up to you 43 million. So imagine if your grandfather really invests, not to say maybe 10,000, you just put 100 ringgit also can, or maybe just 10 ringgit. I mean, I know the money is very, very small back then. Just put 10 ringgit, you at least you worth millions today. So this is what investment brings you, to grow wealth. But of course, this is investment. How they works, basically, it's just like that. The typical things is the three main elements: the capital, the time, and the effort. So using unit trust, going for the higher risk, higher growth, so you are able to grow it better, and your investment will be able to much more easier to grow. Okay, so this is one of the conclusion that we can make. But of course, I'm not talking about, let's say if today you have unit trust, you just go to the bank and say that I want the highest risk. Not like that. Okay. Of course, at the end of the day, because if you want to take on the highest risk, you got to have the expectation that it is going to take time to slowly grow. And the second thing, it might go down in value as well. So you really have to bear with it. If you are the one that, you can't take on losses, you take on higher risk, you go back, and then when you sleep on the bed, you can't really sleep through it. So if you are this kind of person, then you might as well just stick to the conservative. Slowly on, once you understand about the concept, then only you go for the higher risk. Okay. So after talking about all these things, how unit trust helps you, what are the types of it, and how should we go for it? Most of the time, go for the higher risk. But how do we strategize? Okay, as we talk about all this unit trust stuff, I can see a lot of the webinars when they talk about unit trust. Most of the time, they just talk about what is it, what are the types, how do we look at the returns and all these things. But I would like to go it deeper. Okay, I would like to go it deeper to understand the strategy. Okay, how do we actually use unit trust, to build up a portfolio? Okay, step by steps. How do we do it? There are so many unit trusts. For example, if you go into Bursa Marketplace, just go for and search the fund selectors, and then you can look into how many funds are there. Probably hundreds. So how do we actually use it? Okay, so to be honest, I will not talk about like which are the funds that are best or anything like that. I will just talk about how do we strategize using it. Okay, so we'll skip all the things that talk about, oh, this is the best fund, this is the best fund, all this stuff. We will just look into how can you slowly understand and put up a monitoring framework to go for your investment. Okay, so the first part of it, we'll talk about the return objective. Okay, so the first of all, you have to set a clear objective regarding your return targets. Okay, most of the time, the strict guidance I will give is that equity returns most of the time 8 to 10%. As you can see, just now the data, up to 90 years of a sample size, it's also around 8 to 10%. Okay, so if you are the one that actually looking for investment that can give you 20%, 15% a year, okay, please don't come here. You can just turn off the webinar. It's not for you. Okay, you can just go for stocks. I wish you all the best and good luck. But if you just want a consistent return, 8 to 10%, I will tell you it's a pretty good returns, given that your inflation is around 3 to 4%. It's a much more easier way to grow your wealth easily already. So as compared to FD, okay? So because of this, using unit trust is a very, very easy returns. But of course, if you are the one that actually go for the conservative one, then you have to expect the return is only 4 to 6%. Okay, and then the balance fund is actually between of it. Okay, so to understand, you have to go and understand about the target return, whether you want the stable return or you want the high return. Okay, this is a very key objective. So you want a high return, go for the equity or the best one. Go for the technology, the specialized fund. Especially the specialized funds, some of it, they actually give you, maybe, let's say I put up 10 years, they can give you up to 14% also possible. So it's a very, very good performance already. 14% compounding. This is great performance, I would say. Okay. And then you also have to understand the elements needed to profit. Okay, as I emphasize quite a lot of times, the three elements, capital, time, and the effort. There is effort that you need to continue doing it to monitor your unit trust, but it's much more smaller only. You don't have to do research. You just have to look into the performance. Okay. And then the last thing, this is also very, very important. And to be honest, I find that a lot of people, they don't really do this. And it's kind of frustrating me a lot because they just invest listening to the bankers, okay, which is the fee, the constraint that actually might affect your investment. The fee, the lockup period, the personal liquidity issue, or whether the advisor can help or not. These are the constraints. So, for example, the fee incur, we talk about the fee is much more like a brokerage fee. Okay, if we look at unit trust, the fee are most of the time just sale charge. Okay, and if we look at sale charge, a lot of time you need to understand how this sale charge works. Okay, so this sale charge, they actually works by, once you invest into, let's say, 1,000 ringgit, let's say they charge you 5% of the sale charge, then which means your 1,000 ringgit will just become 950 ringgit into the investment. So whether your investment can earn up 5% quickly or not, this is a very key thing. So if this is the situation of your unit trust, so you might have to consider again for the investment, because 5% sale charge is a very, very high investment. And then the lockup period as well. So a lot of people, they actually go for private banking, go for different kind of asset classes. They have a lot of different products. So this product, sometimes they come with lockup period as well. Okay, which means that once you invested, you are not able to sell it at ease in the specific years. Okay, only after the years, only after the time frame, then only you can liquidate it and see how much is it. But this kind of investment, I always say that it's not a good one, because the one that actually lock up your liquidity, the one that actually lock up your capital, this is a very, very bad investment, because you don't really want to go into that kind of situation. If one day you just need the capital, you just need the capital for some emergency or anything like that, then you just harvest. Okay, and also personal liquidity issue. A lot of people, they don't understand about this thing also. To put it simply, if you have an emergency probably in the next 5 years, like for your children education, for housing deposits, renovation or education, all these things, don't invest. Okay, don't even invest in stocks, because in this kind of a period, you are much more frustrated and you are much more impatient. Okay, you are not that patient anymore. So you are not having time with you. So I would say, if you are having this kind of personal liquidity issue, it's much more better for you to just go for bond fund. Okay, bond fund is much more easier for you to understand. Just get the normal return and that's it. End of story. Okay, and the last one, the advisor. This is also very, very important, because you have to understand whether the advisor is actually helping you to, come up with the right funds, come up with the right strategy, and keeping you updated onto your investment. So you have to understand about all these things before entering into an investment. Okay, so this is the key part. Just only by return objective, you have to understand about all these things before entering for unit trust. Okay. And then the second thing will be deciding on the investment strategy. Okay. So deciding on the investment strategy is not about like going to the fund. It's more about how do you invest? How do you allocate your capital? Okay. Whether you want to choose for the lump sum investment, one shot, put it in, wait for the time to materialize, or you want to put it into regular saving investment, slowly put into it, dollar cost averaging. Okay. So regardless of which way of it, I would say this is just a matter of comfortable level, okay? Because to us, to be honest, I will just tell you the honesty, lump sum investment is not really like it's a bad thing or anything like that. If let's say at one shot right now at the moment, the price is low, you lump sum investment into it, and then the market going well, your investment is pretty much good. But if you do it another way, in a regular saving way, so this is much more like a dollar cost averaging every month. And then doing this way, if when the market is going up, you are still earning, but I will say your return is much more lower, because most of the time your average cost is much higher as you go in every month. So I would say, regardless of different kind of investment strategy, it's not really matters like whether dollar cost averaging is the best one or lump sum is the best one. It's much more like your own, I would say, your own comfortable level. Okay, but the most important thing is you gotta have capital whenever the market is down. Okay, you gotta have capital whenever the market is down. Okay, this is a must thing, because whenever the market is down, you need to have the capital to do average down. Okay, if not, you will just miss the opportunity. Okay, so this is very important. So to decide the investment strategy, I will put it simply to say, you can choose the own way, whether to lump sum or whether you do both also can. You just do, let's say right now you have 10,000, you put it 10,000, and then you can have like maybe every month 500, put it into your investment. It's also okay. Okay, but the most important thing is that you gotta have capital whenever the market is down, then you're able to do averaging down. Okay. And then the third step of it. So once you got your return objective clear, and then once you choose how do you allocate your capital in maybe lump sum way or maybe in dollar cost averaging strategy approach. Okay. The third one is the important part of it, which is to choose the right diversified funds. Okay. As I mentioned just now, right diversified funds. Diversify is the key thing. What I mean diversify means that you gotta have the mixture of it. Okay, it's always not the best idea to just go for as I said just now, the highest risk. You gotta at least have a backup plan. Okay, by the highest risk, I'm not talking about 100% just go for the technology funds. It's more about if you are looking at the technology funds and looking at the technology company, the prices are low, you can put up more. You can put up like probably capital of 10,000, you put up to 50% or maybe 40% into the technology funds. The rest of it, how do you do it? Diversify it. So if, let's say, for example, your technology fund is much more concentrated in US market, then what you should do is you should actually give up probably like 20% into Asia or maybe into China. or maybe into Malaysia as well. Okay, so this is how it works for diversified portfolio. Don't go for the one that actually trending. Okay, for example, I understand a lot of people, they always go with the trending funds. A lot of time, banks, they always come up with this idea. Whenever what is the trend right now, they will put up the new fund period. For example, what is the trend right now? If you look at the US market, they always talk about this thing in artificial intelligence, AI. So perhaps maybe the next time when you go to the bank, you ask about funds, they will say that they have the new AI fund already. They ask you to invest. So if this kind of situation come up, always don't go for it, because you got to understand the logic of it. Go for the trendy one, which means go for the higher prices. So this is a very bad investment strategy. So to do it the right way is to always look for the right diversified mixture of it. Okay, be it you gotta have US, you gotta have China, you gotta have Asia Pac, and you gotta have bond as well to make it like a balanced fund. Okay, or if you talk about you don't want to have so many funds, very troublesome. Like I got to do a lot of works like that. You can just go for a balanced fund, but choose the right one. Okay, so this is how we meant the right diversified mix. Okay, so choose the right fund for the target return. Okay, if you want to look for higher return, of course, you have to put it into more into specialized fund, put it into more into technology fund and all this thing. Okay, and then the second thing you have to do is you got to compare the benchmark for the consistency as well. Okay, this is also a lot of people, they don't really have the comparison for benchmark whenever they invest into unit trust. And it's a very fatal mistake, because a lot of time, for example, like this picture, when your fund is earning like 5%, you probably think that, oh, my fund is actually earning at least, not like very bad things. Okay, at least it's earning 5%. But what if I tell you that the market investment is actually like what, 15%? So because of this, right, then you actually lose up a lot. Okay, market is growing like 15%, but your fund is growing 5%. That means that your fund is having a problem. Probably you are in maybe bad, I would say the wrong mixture, or the bad mix of it. Okay, so you gotta fix it. Okay, you gotta fix it. You gotta maybe do some rebalance. You gotta change it. Okay, you gotta change your funds. Okay, it's very important to do that as well, because a lot of people, they always have what we call loss aversion. The funds is losing money, they say that, oh, never mind, I'll just leave it. Probably in the next 3 years they will grow. No, because if your fund is having this kind of a situation, that means your fund is in a very deep trouble. You are having the wrong fund, so you have to do rebalance. Okay, which comes to the fourth step, which is to follow up the investment portfolio. And this is a very important part, because follow up, this is, I would say, like 99% of the investor, they don't do it. Okay, why? Because they just go to the bank, they say that I want FD, the banker introduced the funds, then they just listen to the banker, they invest. This is the wrong approach. Okay, because you didn't do your own work, you didn't do your understanding, you didn't understand about your return targets, return objectives, and all this thing. Okay, once you invested, they wait for 3 years, they do nothing at all. They didn't follow up at all. So this is another mistake again. So no wonder your fund is actually in a bad situation, and all these things. So this is why I'm going to stress how important this is, because this is the most important part that you should really do, which is to follow up your investment portfolio. Okay, so how do we say follow up? Okay, the first thing first is you got to analyze if your portfolio is actually performing as it should. So how do we mean by this? It means that, for example, as I said just now, we invest into technology company. If one day you read on the news, right, and then you saw that, oh, technology company is doing very well. They have all these kind of AI things. Apple is coming out for the new headset, all this very innovative is coming out. And then when you look at the share price, the share price is growing very, very good as well. Then this is the time that you should recall back your investment. Hey, what about my investment? I remember I put up specialized technology investment into this unit trust. So if you look back into it, let's say your investment is just like the picture just now. Your funds literally grow 5%, the market grow by 15%. And this is the biggest mistake that you make. So analyze, you found out the problem. The next thing, what you should do, you should rebalance it. So how do we mean by rebalance? Okay, if there's this kind of situation coming up, then you should just cut loss. Okay, no matter what kind of a return your fund is actually providing to you, whether it's a loss making or actually just 5% returns, you're thinking about, oh, the technology is high, right? So maybe my fund will grow slightly. No, the funds, they will just follow the company. The return, they will just follow the company. If the company already double in prices, but your funds is actually like what, earning 1 to 2%, then it's a bad thing. Then you should just cut off the funds. So this is the most important things you have to understand. Okay. So rebalance, we can have three kind of steps. The first things, take profit. If your funds is actually growing really well, okay, and then for example, your technology, you put it into investment for 40%, they grow by 30 and 40% already. Okay, in your investment, it's up to like 50% of your capital right now. So what you should do, you take profit. It grows so much already. Takkan you just leave it. You just want it to grow and grow and grow. Investment is not like that. It's not always growing up and down. It's a very easy thing. So that's why you should take profit. Take profit, maybe take by half. Okay, cut down the exposure because right now it's 50% of capital already. So cut down by half. Leave it to 25% at a very, I would say, conservative way. So this is one of the way to do it. Or you want to invest more, average down. This is another very important step that I mentioned just now. Okay, to average down. Or the last one, as I said, cut loss. If you found that your investment is not following the strategy, it's not following your objective, okay, then you should cut loss. Find another new one. So this is the most important step that a lot of people actually miss and not doing it. And because of this, I have clients like they leave their unit trust investment with the banker for 10 years. At the end of the day, compounded 2% per year. So they complain to me and they say, I put FD better. So when I told them about this kind of strategy, told them about this kind of concept, then really understand, oh, I should actually listen to how do we invest for unit trust. Okay. And then the last one, okay, this is not like a steps that you should do. I mean, along the time for this strategies, it's not the step that you should do, but it's a very easy way for you to, get info. Okay, so you should engage with the investment advisor. Okay, you should get an advisor that actually much more engaging. Okay, much more willing to share to you. Okay, for example, when you ask them about your portfolio, what is this fund invest in? What is this fund's return expectation? What is the comparison compared to their benchmark? Okay, so you should ask all this kind of question, because once you understand about your portfolio, once you understand more of it, then you're able to have the idea, have the right expectation in it. Okay, and also you can ask them about the market circumstances. Okay, you can ask them about the market situation, whether it's a very good time for you to look for technology. Okay, if let's say they say that, oh, technology is very low right now, you should look for it. Okay, go. Let's say down the road, 6 month time or 1 year time, ask them back again. Hey, how's the technology market? Is it good? Is it bad? So you should keep on following up. Okay, engage with your investment advisor. Okay, so also you can strategize together with them, because most of the time they will be the one that help you to do the dirty work. Okay, so you should really strategize together with them to set up a diversified portfolio. So from there, you're able to keep on track on it. And also the most important thing, set a regular portfolio reviews. Okay, as I said, unit trust, it allows you to ease up a lot of effort and time to not do the research work. But it's also very important for you to have at least the effort to understand your portfolio, or maybe, try to get an idea whether this investment advisor is trustable or not. Because sometimes investment advisor, they always just do for sales. Okay, once they charge you for the sales charge, they don't don't care about you. They just leave it you there. And then they will just tell you, oh, you just wait lah, long-term one. They always come with this kind of explanation. And this is not the right way. Okay, they should be the one that actually engage with you. They tell you that, hey, the market is good and the market is bad right now. So maybe we can top up more. the market is good. No. You try to keep it in the conservative way first. Once the market come down, then we go into the stocks and all these things. So these are the qualities that you should find from your investment advisor. Okay. And then, of course, if you want to strategize for this unit trust, there are a lot of platforms for you to do so. So these are all the platforms that are actually providing for unit trust. And I believe some of you already know the name of it. Okay. And the most important thing is you know the name of it, but you must know the investment advisor. Okay. So it's very important to invest into unit trust. You got to trust someone, and then that someone is the skill you need to have for unit trust, whether the person is trustable, trustworthy or not. So it's important for you to do that. Okay. And here I will just share on the top performing funds for the last 10 years. So as you can see here, the best one, TA Global Technology. This is the specialized funds. So up to today, it's 300%. Okay, 10 years time, 300%. This is crazy return, because in 10 years time, you're able to triple your investment. This is much better investment compared to stocks, I would say. And then the second one, Manulife India. Because India last year, it's a very good market as well, India. So in Indian market, they grew a lot. Last year, particularly it's last year performance. Okay, so this is kind of like hindsight, to be honest. It's not really like a long-term thing, I would say. But for Manulife investment, US equity, so this is the one that actually invests into US stocks. This is much more, I would say, consistent. This fund is very, very good as well. So if you want to look for, US funds, so these are the ones that you can go for it. Then, of course, this is M China A shares. So this is China funds, okay? And it's a very, very good return as well for the last 10 years, 250%. So typically, you can see here, there's a lot of bigs of it for it already. The TA Global Tech, it's a specialized technology fund. India, it's I would say Asia Pac, okay? And then US funds, China funds. So from here, you can really know, like, for example, oh, I see that US right now, the price already go up a lot. NVIDIA already go up like 200% already. So technology, maybe not now. So for example, specialized fund right now, you can cut off slowly a bit. Then for US, China, then you can go for more. China is a much more cheaper price right now. And then US fund, it's okay. The prices are okay, but it's much more at the higher side. So I would say China is the one that we can go for at the moment right now, just to give you an idea. Okay. Okay, then this is the portfolio allocation, as I mentioned just now, the right diversified portfolio. Okay, a mixture of balanced funds. Okay, not too over diversified, also not too concentrated. Okay, it's very important to understand this, which means you don't have to get like 10 different funds, or maybe 12, 15 or 20. You don't have to get as much funds as possible, something like that. No, you can just get easily maybe like 5 to 4 funds, and that's it. But you have to understand each fund, where do they invest? Do they invest in bonds, China, US, Asia Pac? How much is it? So you got to understand about this theory. Okay. Okay. And the last part for the strategy with unit trust, it's to stay invested. Okay. And I can tell you, to be honest, this is the easiest way for you to grow the wealth. But the last part of it, to stay invested, right? A lot of people just fail to do it. Okay, because they just can't stay invested. They worry too much. Okay, they saw their investment probably like stagnant, or go down in price. Then they just say that, oh, I don't want to do it. I just want to cash out and switch, because it's not a good investment. Ended up, it's a very bad decision, because once they come out, the next thing they know, their funds or their investment is growing up again. So you gotta stay invested. Okay, you gotta stay invested. Just as the data I presented just now. If you stay invested since Great Depression until today, your funds is growing like what? Millions. It's crazy. Okay. So as this fund manager, I really like him because he's a really good fund manager, and he used to own these funds back in the 1980s. And his quote about this is that say that stocks are a safe bet, but only if you stay invested long enough to ride out the correction. Okay, this is funny because I remember when I read his book, right? When I was reading his book, he made a really good comparison regarding this stay invested idea. It's a story about people buying a home as compared to people buying on stocks. Okay, so a lot of times you hear from your family or maybe your parents buying into home, okay, from a small one first. It's a sure win strategy. You buy a small home first, buy a small house as your investment, earn your income, pay the loans, pay as much as possible. Every month, pay slightly extra for the repayment. So your loan's probably like 35 years, it ends up like 20 years already finished. So once you got the capital, right, maybe like 10 years down the road, or maybe 15 years down the road, your income grow. You can get a bigger home. And then the small home, you can sell it. And then the market value, it grows already. So that's why you get a bigger home and then your wealth is growing. This is the best investment you can get. But this is an interesting fact because a lot of times when you think about it, if you buy a home, right, okay, a lot of times you will make a lot of research yourself. Okay, you will drive around the tamans, you will see that whether they fix the things or not. Okay, the playground, is it run down? Or let's say if run down, they fix it in the next 3 weeks. Oh, it's good. It means the management is actually doing their job. They're doing their work. So you do all kinds of research. Or maybe you just want to look for curtains. You will go at least probably a few shops and go to IKEA, compare this and compare that. Go into Shopee as well. Look at the prices, whether you are buying high or buying low. So all this kind of research you will do. So if you look for renovation, you will try to understand whether the contractor is charging you high or low. And then you will go with him to understand all this kind of design. You'll try to choose the best design for you. Okay. So you see, when you buy a home, right, you make so much of homework. You do so much research and effort just to buy a home. No wonder you can invest happily and successfully because you do a lot of research already. Okay. And then not to mention, you stay invested as well. Because you buy a home, right? Takkan you just buy 1 year later, you just sell it off. Cannot be, right? You definitely just continue it. No matter what kind of people give you doubt. They say that, wow, your kitchens look very bad. You renovate it like that. You buy this kind of table. Wow, overpriced. So what? You will continue staying at the house. You will continue stay invested for the home. But if you think about it, when it comes to unit trusts, or maybe comes to stocks as well, you don't do this kind of investment research. What you do, you go to the bank, the banker talk a few words, you just say, okay, I trust you, I buy. Next 3 months, you see that the investment is not doing well. You say, oh, no, I sell off. Not even 1 year. And to mention, homes is like people stay invested for like average 7 years per home. So to invest in funds, you use up 3 months. You stay invested for 3 months and you expect the returns to come out. So this is also a very good comparison when I was studying his book. And I really like the idea that I say that, I talk to a lot of people, I say that you gotta stay invested for all kind of investment. And for unit trusts, it's a very easy way for you to, as I said, to invest. You don't have to do a lot of the work. You just have to understand yourself. What kind of return I want? What kind of a strategy I want to put up? What kind of approach? Whether I have the capital right now or not. If not, maybe I put every month. What kind of investment I want to go for? Is it maybe the highest risk? Okay. If let's say the highest risk, I will talk to the investment advisor. I will say that I want the highest risk. I want the most capital gain. I can stay invested for like next 3 years, 5 years. It's okay. Okay, I will just continue. But you gotta have regular review, regular update to me. So this is how we invest with unit trust. Okay, slowly you will find that this is a very easy way for you to get better returns over the long run. But you have to do your parts. You have to do your parts well. And then the most importantly, as I mentioned just now, stay invested. Okay, so this is the end of my today's section for unit trust, and I hope you learned something more about unit trust today. Thank you.
Thank you so much, Dibo, for doing this segment for us. I guess today we have gained enormous value understanding what are unit trusts, how to evaluate the performance, and what are the investment strategies we can use to manage our portfolio through unit trust. So if you have any questions to ask our speaker today, you may write them in the Q&A box. Okay, write them in the Q&A box, not the chat box, so that I can manage this Q&A effectively. Okay, one of you asked, you miss out the front part, right? No worries. If you miss out the front part, you'll receive the recording link tomorrow.
Oh,
okay. Yep, you'll get the recording link tomorrow. No worries. All right. So, Dibo, is there any minimum investment that we need to park with mutual fund?
Okay. This is actually a good question because I would say that there's literally no minimum amount for you to invest into unit trust, because to be honest, investment for unit trust, it can go to as low as 100 ringgit, then you can already start investment for unit trust. But for stocks, of course, it can go much lower, maybe in 50 or 80. But I would say that unit trust, although it can go as low as 100 ringgit, but the most important things you have to understand, your capital is low, that means your return gonna take even longer time for you to really grow. So if you talking about like, oh, I only have like no capital at all, then I would suggest to put up maybe a consistent monthly investment. So every month you put up like 100 to 300, then slowly it grows. It's a much more easier way for you to grow well. But to answer the question directly, no, there's really not much of a minimum amount. It can go as low as 100 ringgit, then you can do this already.
All right, so it can go as low as 100 ringgit, no minimum requirement. No minimum capital requirement.
Yeah, exactly.
The next question is, does unit trust pay dividends or interest?
Okay, of course, unit trust, they do pay dividends, interest as well, and all this stuff. Because these are the returns that that you guys are entitled. Okay. So the most important things that it's not called dividends or interest. Okay, it's called income distribution, and it's most of the time at the end of the day, the fund manager will just distribute the income to you. So yes, you guys are entitled for it. So definitely, it is entitled.
So you mean there's an increase in NAV lah, correct?
Yes, exactly.
Okay. Because there are just so many assets in the portfolio, right? If every time give a dividend, every week maybe there will be dividend payout.
Yes, exactly. So because of this, so a lot of times, income distribution, the funds will decide the time to actually give out the income distribution, instead of like whenever the company give you dividend or whenever the bond give you interest, right, then they straight away distribute to you. It's not like that. But definitely they will just keep it to the trustee, and then once the date comes, then they will just distribute the income to you.
All right. The next question is by Wu Yin. What is the acceptable sales charge if 5% is considered high?
Okay. To be honest, I would say that if you really want to compare about this sales charge, right, I will give you an idea about, perhaps we talk about stocks. Okay, let's say, for example, stocks brokerage, typical one, it will be 0.1%. Enter, and then exit another 0.1%. So typically you can say that per transaction is 0.2. Okay, so if you put up, for example, 5% for your portfolio, for your unit trust, and then you try to understand how many times your stocks actually needed to trade. Let's say, for example, 10,000 ringgit. Okay, 10,000, you go into unit trust. It go by once, right? Go by once 5%. But if you imagine 5% divided by 0.2, your stocks, right? If you 10,000, if you put into stocks, right, in 1 year time, it has to probably traded 25 times, which means that you have to trade around like 200 Yes, 250,000 of value transaction, then only it comes up to 5% of the sale charge. So typically, to give you an idea why 5% is very high, is because of this. But if you talk about what is the acceptable level, I will not really give you an idea, because a lot of banks, they have different kind of way, and your investment advisor, they can negotiate the rates to you as well. Sometimes they give 3%, sometimes they give 2%, but 5% is definitely the highest one. And if you just go for 3%, then it's much more better. But if you can, then 2% is I would say, the much more acceptable rates that I can go for.
2% lah. So that's the benchmark. Is there any difference in fee if we purchase unit trust through like unit trust agent, or or bank agent, or a certified financial planner, or registered financial planner? Is there any difference?
Okay, it's not really that there is much difference. It's much more like I would say, the fee. If you talk about unit trust, the product itself, at the market right now, we have two kind of fees. One is the sale charge. Another, it's a much more newer fee. It's called rep fee. Okay, so these are the two I would say charges. Okay, that you can actually look for, and of course you gotta have. You can look for the lowest sale charge as low as possible. So most of the time, I can say that if you want, you can invest during your birthday time. So most of the banks, they do give this kind of promotion campaign, birthday campaign, if you 1% sale charge and all this stuff. But to invest with, let's say, for example, the financial advisor, or to invest with bank, or to invest with some financial planner, something like that. The difference is much more like the services. Okay, the difference is much more like services. Of course, if let's say the financial planner, they charge you for extra service, then it's a different story lah. But if only just coming from the unit trust itself, it's much more like a services, which means that let's say, for example, a financial planner, they can give you better service because let's say they understand the market more, they give you more care, they give you more regular updates, then it's a good thing. But if let's say if you go for the bankers, some of the bankers, most of them I heard is like that lah. The bankers, they are, they are much more like the one that once you enter, they just leave it. They don't care about you. When you ask them about, hey, how's my investment? They just say that, oh, it's a long-term one. You just leave it, long-term one, stay invested. Then it's a bad one. That is the bad investor. So you have to be careful with it. Something like
that. All right. Thanks for sharing your perspective in this issue. God Kim would like to ask, on average, how long should we stay invested in a unit trust to see the return?
Okay, this is a very interesting question. But I would say it's more like this. Okay, it's not about the timing to look at the returns. It's much more like, for example, whether the places that you invest, it's growing, or whether it's just stagnant. For example, let's say just now I mentioned, right now, I do think that China is a good bet right now. China is a good investment right now because the prices are low, and then they have quite a good upside moving into forward. Let's say they recover and all this stuff. But you have to understand, when you look at the funds, let's say, for example, right now, today, after this webinar, you invest into China, and then maybe down the road next year, June, when you look back into your funds, you see that there's no return at all. Okay. But the next thing you have to understand is you should go to the China market, whether they are growing or whether they are still stagnant. If let's say they are continued stagnant as well, nothing changed, then this is not really your fault lah, because the market is really like that. But if let's say, for example, the China market is growing and your fund is just like nothing move, right? Then this is bad thing. Then you should just come out and then just cut off your China investment. Maybe that is not the right fund that you choose. So it's not really like, for example, you have to wait for 3 years or 5 years, then you can see return. For example, I have clients somehow invested into technology this beginning of the year. They already got like 15%, 10% of the returns already. So you can see immediate result straight, within a month's time. But of course, let's say you invest in bonds, then bonds is the stable one. So you have to invest for a very, very long year. Then you can see up to 10% or maybe 15%, something like that. So this is much more like the most important thing, rather than looking at your funds and hoping that you will see the return quickly, something like that. No, you should actually compare it. Try to understand whether your fund is invested into the right fund, the right market. If the market is growing, your fund is growing, then it's a good thing.
All right. Thanks so much, Dibo. Let's do one last question on my screen today. Just now you mentioned that, we need to stay invested, but you also mentioned that we need to cut loss when it is time, right? So the question is, Sue asked, how is that working together?
Okay, yeah. So this question is actually much more similar to the one just now I answered. So as I mentioned just now it's much more coming from the perspective, how do we see returns? When do we see returns? How long it takes. But for this one, particularly for cut loss. So as I just an example, like just now the example, China is growing for the next 1 year. Okay, let's say China's market is growing for the next 1 year. But if your funds that is actually invest into China, maybe coming from your investment advisor, coming from your banker, something like that, they say that this is China fund, something like that. But you see that 1 year later, China is growing really well, but your fund is not growing at all. Then you should understand this is something wrong and you should cut off the funds. So this is when you should cut loss for some of the funds. But of course, except for this one, there's another one. It's very, very important as well, which is the trendy fund. Okay, it's also very important for you to try to always avoid for trendy fund. For example, I mentioned in the slide just now, if you somehow comes to the bank and then the bank says that, oh, I have the latest fund. Once you heard about the words latest, so you should flag up your red flag. It's a red signal already, so it's a bad thing. You should be careful right now, because it's always like that. For example, people always go for the trendy things. So to the banks as well. They always come up with the trendy funds, trendy teams, something like that. Green funds, or maybe AI funds, disruptive funds, all these kind of things. It's always much more like a lagger things. The prices goes up already, then only they will come up with the funds. So at that point of time, if you go into this kind of funds, it's a very, very bad idea. And most of the time, it's very huge losses coming from that.
All right. Thank you so much, Dibo, for doing this segment with us. So, ladies and gentlemen, you just heard from Mr. Dibo Chua, who is an analyst with Bullbearbursa. All right. So for our next session, it is titled How to Avoid Emotion-Based Investing. So it is happening tomorrow morning, 10 a.m. to 12 p.m. So here is how you can register for the session. Let me just give you the link here. So if you want to learn how do you avoid emotion-based investing, how do you control your emotion in investing, then you must tune in for our session tomorrow morning. So that will be conducted by Ms. Pauline Yong. All right. So with that, I want to thank all of you here for staying tuned until the end of this session. So I'd like to thank Dibo for doing this segment with us. So now we know how do we build a consistent portfolio with unit trust. So goodbye, everybody. Hope to see you in our webinar tomorrow. Okay. Bye, everybody.
Thank you, everyone. Thank you, Shane.
Thanks,
Thank you for having
Dibo.
me today. Thanks.
Yep.
Bye-bye.
Bye-bye.